Thanks for your interest in International Tax Course videos. If you'd like to purchase the entire course, click the link in the description. If you're watching this on mobile, you can click the downward arrow here and it will show you the link to purchase the entire course. So what are some of the considerations that are considered by the countries at the time of entering into a tax treaty? Now, while tax collection is one of the most important consideration of entering into tax treaties, basically there are other factors as well. Like I said, collection of tax is one of the most important and the first criteria for entering into a tax treaty. It might just be that there is a non-resident who is deriving some income from India. Now, it may not be always possible for the Indian government to collect the taxes from such non-resident which are sourced from India, because such a non-resident may not have any office or any other place of business in India. In such a case, if there is a tax treaty with the country where the non-resident is actually a resident, then by using treaty mechanism, you can actually collect taxes from such a person. The second is technical collaborations and transfers. Now, if there is a country which is low on technology and it wants that the technology should be imported into it from countries where the technical capabilities are high, it would want to enter into a tax treaty in such a manner that the benefit is given to the companies who are providing technical know-how, collaborations, and as well as technical transfer. This is for the simple reason that the more the technology is imported into a country, the more is the economic benefit arising out of it. So if for that reason they decide that we want to give away our right to tax, then that is a technical collaboration and transfer consideration which is considered by a country. The third is trade and political consideration. Now, obviously, if a large amount of trade is something which can happen into a country by providing some tax benefits, the countries will consider that while entering into a treaty. And of course, wherever you have friendly relationships at a political level with a country, you are likely to provide them more benefit, or you'll be more flexible in your approach in terms of the revenue sharing vis-a-vis a country where you may not have any political advantages. It is the bargaining power which governs the term more than any other consideration. What I mean by this is, think of a case if a country has a large amount of technical capabilities. They are obviously going to have more bargaining power when they are discussing the same with a country which wants technology, right? So it is the bargaining power which determines the term as to who's going to be benefited more and who's going to be benefited less in terms of deriving the tax revenue, rather than a consideration as to what is fair and what is not fair, or where the source of income is and where the source of income is not there. But definitely these equations can change over a period of time, right? So let's say, for example, the India-Mauritius Treaty, until the current press release which we had, was tilted in the favor of Mauritius, because Mauritius had the right to tax the capital gains, right? And as we all know, since Mauritius did not have any capital gains, effectively capital gains arising from sale of shares of an Indian company were not taxable in Mauritius. But then, now the Indian government has come up with a press release where they say that they are entering into a protocol with Mauritius, right? And that protocol will give India the right to tax income which is sourced from India.